Most people believe banks were created for a simple purpose: to keep money safe and help economies grow. It sounds reasonable. After all, banks hold deposits, give loans, and keep the financial system moving. But the real origins of modern banking tell a much more complicated story. The system we rely on today didn't emerge overnight, and it wasn't designed purely for convenience or public good. Modern banking grew out of a mixture of necessity, opportunity, and power. Merchants needed ways to move wealth across dangerous trade routes. Governments needed money to fight wars they couldn't afford. And financiers realized that controlling credit could be more powerful than controlling gold. Understanding how banking truly began reveals something important. The modern financial system was built less around storing wealth and more around creating and controlling it. To see where this story starts, we have to travel back to medieval Europe, when long-distance trade began expanding rapidly. Merchants were moving goods across continents: silk from the East, spices from Asia, wool from England, and wine from Southern Europe. But carrying large amounts of gold or silver across these routes was dangerous. Bandits were common, wars frequently disrupted trade routes, and transporting heavy coinage across hundreds of miles was inefficient. So merchants started looking for alternatives. One of the earliest solutions came from Italian trading cities like Florence, Venice, and Genoa. These cities were the financial hubs of medieval Europe. Wealthy merchant families began offering a service that would slowly change the economic world. They would hold deposits and issue written promises of payment. Instead of carrying bags of coins, a merchant could deposit gold in one city and receive a written document guaranteeing payment elsewhere. These documents were early versions of what we now call bills of exchange. They solved a major problem. A merchant traveling to another city no longer needed to carry physical wealth. Instead, they carried a piece of paper representing that wealth. If the paper was trusted, it could be exchanged for coin at another banking house. Trust became the foundation of finance. But something interesting began happening once these banking families started holding large amounts of deposits. They realized that most depositors didn't come back to withdraw their gold at the same time. This meant the bankers were sitting on large reserves of idle money. And idle money in finance is an opportunity. Instead of simply storing gold, bankers began lending a portion of those deposits to other merchants who needed capital for trade. The borrower paid interest, the banker earned profit, and the original depositor still believed their money was safely stored. This practice, lending out deposited funds while keeping only a fraction in reserve, would eventually become the foundation of fractional reserve banking. At the time, it was a quiet innovation, but its consequences would echo across centuries. One of the most influential banking families of the medieval period was the Medici family of Florence. By the 15th century, the Medici Bank had branches across Europe, from London to Rome. They financed trade, handled papal finances, and helped move enormous sums of money between kingdoms. Their power didn't come from owning gold mines or land, it came from controlling credit. Kings and governments frequently borrowed money to finance wars or political ambitions, and when rulers needed money quickly, bankers became indispensable. This relationship between banks and governments became one of the defining features of the modern financial system. A government that could borrow large sums could fight longer wars. A banker who financed those wars gained influence and profit. Over time, finance and political power became deeply connected. But medieval banking also had limits. Individual banking families could collapse if loans went unpaid or if political alliances shifted. When major borrowers defaulted, especially kings, the consequences could be devastating. This happened dramatically in the 14th century when England's King Edward III defaulted on enormous loans from Italian banks to fund the Hundred Years' War. The resulting financial shock contributed to the collapse of some of Europe's most powerful banking houses. For the government, it provided a steady source of financing beyond taxes. For bankers, it created huge influence over currency. Over time, other nations adopted similar central banking systems. Unlike gold or silver coins, paper money relied entirely on trust in institutions and governments to maintain stability. It illustrates an important truth about modern banking. The system doesn't merely store money, it actively shapes the supply of money. Banks create credit. Credit expands economic activity. And when credit grows too quickly, financial instability can follow. This pattern became especially visible during the financial crises of the 20th and 21st centuries. During periods of economic optimism, banks tend to expand lending. Businesses invest, consumers borrow, and asset prices rise. But when confidence disappears, when borrowers can't repay loans or markets begin to fall, credit contracts rapidly. The same system that fueled expansion can suddenly amplify collapse. That's why banking crises have been a recurring feature of economic history, from the banking panics of the 19th century to the global financial crisis of 2008. This is why governments and central banks often intervene during financial crises. They act as lenders of last resort, providing liquidity to banks and attempting to restore stability. Without that support, even healthy institutions can fail during widespread panic. But this safety net also introduces another complexity. When banks believe they will be rescued during crises, they may take greater risks during good times. Economists sometimes call this the problem of moral hazard, when protection from failure encourages behavior that increases the chance of failure. This tension between stability and risk-taking has become one of the defining challenges of modern banking. Yet despite its vulnerabilities, the banking system has also played a central role in economic development. Access to credit allows businesses to invest in new technologies, build infrastructure, and expand production. Mortgages allow families to purchase homes. Loans enable entrepreneurs to start companies that create jobs and innovation. Without banking, modern economies would operate far more slowly. But understanding the hidden origins of the system reveals something important. Banks were never just vaults for storing money. From the beginning, they were engines for creating financial activity, sometimes productively, sometimes dangerously. The same mechanisms that helped merchants move money across medieval trade routes eventually evolved into global networks capable of moving trillions of dollars in seconds. The scale has changed dramatically, the underlying principles have not. At its core, modern banking still operates on three foundations that emerged centuries ago: trust, credit, and the partnership between financial institutions and political power. Trust allows paper and digital money to function as real wealth. Credit allows banks to multiply financial activity far beyond the physical money that exists. And government backing ensures the system remains stable enough for economies to depend on it. When those three forces remain balanced, the financial system supports growth and innovation. When they fall out of balance, crises emerge. That's why the history of banking is not just a story about money, it's a story about power. Who controls credit, who decides how money is created, and who bears the cost when the system fails. The merchants of medieval Italy probably never imagined that their simple solution to transporting gold would eventually evolve into a global financial architecture. Yet their innovations laid the groundwork for everything that followed. From Renaissance banking houses to modern central banks, the evolution of finance has been shaped by the same fundamental challenge: how to move value efficiently while maintaining trust. Understanding that history changes the way you see the financial world today. Because once you realize how the system was built, you start to see that banking isn't just about protecting wealth, It's about shaping the flow of wealth itself. And the institutions that control that flow hold enormous influence over the modern economy. If this gave you a new perspective, hit subscribe. History doesn't just explain the past, it reveals the forces shaping the future.